President Donald Trump narrowing his choices to replace Fed Chair Jay Powell to 3 or 4 names, saying he'll announce his nominee a little earlier than initially expected. Joining us now is the former economic advisor to President George W. Bush, Marc Sumerlin. Marc, of course, your name has been in the mix as well over the past week or so. Welcome to the programme. Let's just start with the base case, the case for rate reductions. Marc, what do you think the strongest case is right now?
Right. I think the strongest, first of all, thank you very much for having me. I think the strongest case is we just have to mark to market to the new data that we have. The data was revised very strongly to the downside on the jobs, and that's the most important data that we have. And so it's, jobs for May and June only came in at 33,000 combined for those 2 months. And so had we gotten those in real time, it's likely that the Fed would have cut probably in June and July. And we know that the economy barely grew over 1% in the first half of the year. And so a 4.33% Fed funds rate is just too high for the economy that we have right now.
Marc, can we stay on that payrolls data? Because there's been this great debate on Wall Street, and I have to say it's very divided at the moment. Do you think that step down in payrolls growth, and clearly you do think it speaks to a cyclical turn and not a structural shift? But can you tell us why you believe that's the case? What the distinction is between one versus the other?
Absolutely. I do think it's cyclical. I mean, I think if you step back, like very big picture macro, we have fiscal tightening this year from the tariffs. Next year, we're going to have some fiscal loosening from the tax bill. And behind all of that, we have the AI productivity gains starting to take hold for the first time. And so it's a pretty mixed, confusing macro picture. But you got to kind of ride it out in real time. And so we just know, like before the data revision, there was a disconnect between jobs and GDP. And then after the revision, there was no disconnect. Jobs got revised down to reflect what was going on elsewhere in the economy. And it's really important to mark to market to where we are and not just to say, oh, well, whatever we had before is still fine for the Fed funds rate.
So let's do some scenario analysis. Let's say you become the next Fed chair. Congratulations. And let's say in September you cut by 50 basis points on the heels of some of this jobs data. And then you see 10-year yields shoot higher, akin to what we saw last year when the Fed cut significantly. What do you do?
Then you stop. And so one of the reasons I support the 50 basis point cut right now is that you have the inversion in the front end of the curve. That's something like 60 basis points last time I looked. And so you know that you can cut by that amount without really upsetting things. But the weakest part of the market or the economy right now is housing. And so you can't have the long end go up. And that's your constraint right now. And so if the long end starts to go up on you, you have to stop cutting. It's that simple.
You could make the argument that if the market, if sort of this collective decision-making body truly believed that the economy was significantly weakening, the 10-year would be significantly lower. Doesn't that sort of indicate that there is enough strength to continue at this sort of pace with these rates? I mean, isn't that some sort of signal in and of itself?
I think if we go back to January, a lot of the best bond traders on the planet thought the 10-year was going to be at 5 or over. And so the fact that we're at 4.29 instead of 5 is a reflection of the weaker economy in my mind. So these things are always judgment calls, but I think right now you have the scope to cut by 50 basis points, and then after that you'd have to look at the data and you'd have to look at the markets and you have to look at what's going on in the real economy and put it all together.
Marc, I'd love to know if you can share with us what your approach would be if you had the honour of taking over the top job at the Federal Reserve. We heard from the Treasury Secretary, who was sitting around the table with us just a few days ago on this programme, and he talked about the need for foundational change at the institution. What do you think needs to change?
First of all, I think that the staff is all set up wrong. To do the job correctly, you have to understand 3 things. There's the data and there's the economic modeling side, and all of the staff, basically, that's what they do. And then you have financial markets. You need to understand what's going on in high yield spreads, what's going on in oil markets, what's going on in bond markets. And then you have what's happening in companies. And especially right now, at a time of so much change, you really need to understand what's going on with AI and productivity gains in companies. And so I would like to have the staff completely change where a third of it is doing economic modeling type of stuff. And then a third of it is real sectoral experts. I mean, the Fed chairman should have someone who is an expert in autos, an expert in retail sales, an expert in every single thing in-house, so that you really have the pace and the feel of the economy going on, as well as more market people there that understand, okay, spreads are blowing out, and this is why we need to worry, why we don't need to worry. And so for me, it's less of a I don't have a problem with the size of the staff, because I think, the Fed is so mission critical to the whole world. I just think there's just so much redundancy. And right now it basically functions as like a university research department. And I don't know why that's the case.
Mark, this actually raises a point that John's been talking about significantly, which is how much does that mean a more active Fed when it comes to balance sheet management? And it's not just quantitative easing, but also just the denominations of where you buy. I mean, if you treat this more like a markets operation than a university, how much more active does that balance sheet become?
Yeah, that's a good question. And I think that the balance sheet is an important tool when you need it. So definitely in crisis, it's something that's in the toolbox and it works. I don't think it works that well or needs to be continued after the crisis is over. And so, if we were coming out of the pandemic or something, I would have definitely ended the QE sooner rather than later. But they're important questions right now when we have very high mortgage spreads about why are we still selling off MBS when we have 150 basis point spreads that are hitting the housing market right now. So I think you just have to look at it very objectively about what's the impact of the balance sheet in the real time. And there's some people who would love to go back to the old days when there was no balance sheet. And I think that's a fine argument if we could rewind time back to 1995. It's just very hard to go from where we are now to that type of operation.